Good morning. Good morning. It's Saturday, May 20th. This is just a small video on some of my notes that I've wrote in the last couple of days. One of them was on price action, and the other was reviewing the JPOW. But this is something I have wanted to do because I think price action is a fascinating concept. And really, you think about it in terms of what makes price the way that it does, right? And so, like, you go to buy a car, and the car is priced, I don't know, maybe like $10,000. You go buy a house, and the house is like $100,000, and then you go buy an apple at the market, and it's $1, right? And we're not. I know, like, this is kind of a random example, but it's like, are we talking about crypto? Are we talking about different assets? It's like, well, yeah, if we're talking about, it's the conversation that we have every day about crypto is like the price. It's like I'm buying Bitcoin here at 26,935. But it's like, why? It's like, well, I think it's going to be a higher price than it will be at its current time. So this is a lecture about price action. It's a lesson about not necessarily charts, and I'm going to show you a chart and tell you what it does, but like when you look at a chart, you're thinking about the data of where price has been, and you're using that to predict where price is going to be, and that's really what price action is. And I'm just going to read a few of the notes, and I'll go over the stuff on the the chart, and it'll just be like a different way of looking at price action, because I do think that when you have a sort of solid grasp about why markets move the way they do, you can form a methodology, or you can copy somebody else's methodology, and you understand why it works the way it does. Like, let's say, if you use JR's methodology, he has like the VWAPs and the the value area lows and highs and very key levels on the fibs, and it's like these form areas where price is likely to be accepted or rejected at, and we just wait and see if there's confirmation. Like, you see the net longs, and you see the CVD, and you see the volume go up, and it's like, yeah, well, buyers are stepping in and buying at this price, and or buyers are actually rejecting this price and we're going down. So, but the methodology is underlying is kind of a tool. It's a strategy of working with a very fundamental principle. It's like, well, why does price trade at 1354, and why does it trade at 2129? Like, these are kind of very questions that not many people answer or ask themselves. And when you go to like Twitter and you think, okay, you know, BitBoy thinks that ADA is going to $10, and you really have to actually critically think, it's like, how is it going to get to $10, right? Like, and so this will be kind of a funner lecture on concepts, and maybe some people will find some really interesting insights that can improve their trading or improve the way they think about trading. And I'll go over the list that I made a few days ago, and this is also for Crypto Shark. So, price action rules. Price is the structure given the input of many different variables. So that's very true. Like, it could be supply and demand imbalances. It could be that there's a aggressive amount of traders in any direction pushing a price. It could be that the economy is very risk off, and so things are selling off, or people are dumping assets onto the market, right? But the final variable that we actually look at, so right now, the price of Ethereum is at 1820. So that 1820 is the output of multiple different factors determine the market. It's the way that market makers are quoting the spread. It's the way that traders are jumping in and out of the market because they find an opportunity there, and it's a way that these traders are also getting pushed out of the market because you know the sellers come in and recognize like there's some over leveraged longs, and so they push the price. And so, yeah, the price is just moving, but it's like there's so much complexity to what happens in price and why it is the way it is. But one of the cool things is, and this is kind of a rule tool that I have, is that price is fractal and universal. So as I talk about, you buy an apple at the market, you buy a car, you buy a house, you go and buy a service, and like the reason, and like they all follow a certain level of rules and patterns. And so these rules and patterns can be, of course, applied to, Bitcoin and Ethereum and many of the other shit coins that you like, but also to like commodities and gold and things. So learning about price action, you're learning about sort of like this universal structure. And this is also why I think math is very important in trading, is because, well, when you have, like, let's say a high and a low, that I'm gonna actually write a fib, right? Like, say you have like a high and a low. Well, that is a structure, right? Like there's a mathematical structure about where price could accept and reject, and that is formed by, the potential participants participating in the market, right? And so is math magic? Well, not really. It's just like math is the kind of language in which you understand whether something is priced fairly or not fairly. And it's always unfair because it's always moving in that case. But as I said, the price is the end of multiple different factors. We could say it's supply and demand. It could be leverage. It could be squeezes. It could be traders that are forced and trying to get out of positions. But the final outcome is just being our current price, which is 1820, right? And so another rule to this is that if price is staying in a consistent zone, then it's sort of at a fair value, right? And so, you could see like, okay, we're ranging here or consolidating, here is here and here is here. And there's a really cool theory called auction theory, which is like, you can always think of the market as a continuous auction, right? Like there's traders coming in and out of position and they're saying like, well, I think this is fair value. Like, let's say, we had this summer last year and, Ethereum was considered at fair value for a couple of days here because it was just consolidating or ranging, right? And then we got to here and it was like new value, and here's a new value, and here's a new value, and here's a new value. And what this is that price is moving from zone to zone to zone because you have like, okay, well, this is fair value, but buyers were actually getting stronger and they're saying like, well, I think this is actually cheap. And so they came in, they overwhelmed the sellers, and now we're here. And now we're in kind of a new level. And it's like, well, I think the price is now too expensive, and so sellers came in very strong, buyers got pushed out, and then the market sold off. And then it goes to a different value area. And so it's like a continuous auction. So imagine like you're in a housing market and everybody's like buying and selling houses, and they're saying like, oh, like I'm gonna buy a house. I'm gonna buy a house. I'll pay 1,000. I mean, fictional houses. And it's like the other guy says like, no, I'll pay 11,000. The other guy over there says like, no, I'm gonna pay 13,000. Until someone says like, okay, sold. I'll sell you it for 13,000. And therefore, that's where the market actually, the auction ends. And so this is sort of how auction value theory works. And so, and it's the same with price, right? Like you could think of like Bitcoin and Ethereum right now being in sort of like this bidding war, right? Like traders are arguing on Twitter. It's like, no, I think Bitcoin's going to go up. We're going to have a short squeeze. This is cheap right now. You should be buying. I'm buying here right now. And the other person's saying like, look, the macroeconomy is shit. This is stupid. I don't think anyone's buying Bitcoin, and I'm going to short. And so that's kind of like the price. Well, the price is always right? And so the price is that we're at 1820, and so that's the actual true measure of value. But you have people forming narrative about the prices, like it's too expensive and that's too cheap, and they're pushing it to different value areas. And so when you're looking at exit charts and you're really thinking about these like volume pointed controls and these time pointed controls, you're really thinking about like where people are thinking, okay, well, if it's underneath the VWAP, then it's like it must be cheap, right? And then we retest the VWAP and actually we don't reclaim it, and it's like, nah, like it's actually expensive, and so we kind of retreat and return. I should probably try to show you that on a chart, but but like I'm just kind of like trying to add a little bit more context to, let's say, JR's lectures and like the things about like why does price move the way that it does? Why does it move the way like J. Powell says it does? So another thing that I wrote too is, if the zone at which price trades at is the market structure and expresses itself in terms of a range, a trend, a channel, or a chop, right? So you could look at a theory. You can look at Ethereum right now, and it's like there's different multiple market structures, right? Like this is a range right here. This is sort of like very choppy, not really clear. This is also another range. You have an uptrend right here because it's higher highs, higher lows, higher lows. But like, back here, it's definitely a downtrend, right? Lower highs, lower highs, lower highs, and lower highs. And so those market structures are telling you about a relationship between buyers and sellers, right? It's if the sellers are stronger than the buyers, then we're going to downtrend, and if the buyers are stronger than the sellers, we're going to uptrend. And if there isn't really a consensus, then we're going to range, right? And so when you're thinking about the markets, you're thinking about the charts, you're thinking like, okay, no matter what people say, unless it's proven otherwise, unless sellers can push it below here, and unless buyers can push it above here, we're in a range. But if you look at it from kind of like a little more meme line, the price has actually been consistently going up. So you could say we're in an uptrend. And thinking about market structure and thinking about how the context of like market structure being a relationship between buyers and sellers, and then you put a chart and you create a thesis about like you create your fib thesis or you create your gone thesis, and you can help understand about like thinking about, okay, I'm actually entering a trade because I think that the market's actually uptrending, and so I'm just going to buy the dips and go up. But if the market changes structure and say like, okay, well, starting to look very bearish, then you might switch short, you might cut your position because the invalidation is that, well, buyers are not supporting the price. And so your reasoning for cutting the position is because buyers aren't supporting the price, not because the price has to go there or the price is not going. It's just because price is showing you what buyers and sellers are doing at all times. And price stays into the market structure until it breaks, which was kind of going up to that previous rules, like until it says otherwise, like until like this trend line really breaks, then we're sort of in an uptrend. But you can definitely make cases that like we're kind of downtrending or stuff. We're forming a triangle, which I think is actually a potential market structure break in or it's buyers and sellers kind of consolidating in like very, very tight lock disagreement until one side pushes the other out, and that's usually expressed, of course, in volume. And so talking about kind of like liquidity is that traders take liquidity and market makers provide liquidity, right? So like the reason that price is at 18-19 is because market makers are creating this kind of spread for traders to enter, right? And if there is no traders who want to go into here, the markets are kind of remove liquidity, the price is going to mark down to another level. On the other hand, if like there's actually like no sell liquidity, then price will just keep trending up until there's liquidity. So market makers are providing liquidity and traders are selling liquidity. An example of this is like you go to a flea market, right, and you could sell toy cars, right? And so there's a market maker and he's buying the toy cars and he's also selling the toy cars. And so the price of toy cars is like right now 18, like the Ethereum price. And it just means that like he's the intermediary. But if he's seeing that, okay, a lot of people want to sell all these toy cars, I don't want to buy it. So he's going to keep the liquidity is going to keep marking down. The price is going to trend down, 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 down. And if a bunch of people want to buy toy cars, then it's like, well, they're going to try to provide more liquidity upwards, and the price is going to mark up. And that's known as what we call like a supply and demand imbalance, right? Because there's changing demand. So if there's increased demand in Ethereum, then the market makers, they're going to provide liquidity. They're going to provide bid side liquidity because people want to buy, so they'll provide bid side liquidities, and then the market will actually keep trending up. The same with people, like there's a supply imbalance, meaning that there's a lot more supply in the market than there's demand. Traders are coming into demand like to sell off that liquidity, so the market makers are sort of like trying to let the price just fall until buyers step in until you see buy side liquidity. And so you could think of liquidity as type of like entry or exit for trades, right? Like for like if you want to sell a Bitcoin, somebody on the other side of the trade has to buy Bitcoin. And if you want to buy Bitcoin, somebody on the other side, the exchange has to sell you it. And they want to sell it at the best possible price. And if there's too many buyers, then they're going to like keep marking up the price until somebody comes in. If there's too many sellers, they're going to lower the price until somebody comes in. And so that's the way you can look at the market too. It's not just like, oh, I draw a chart and I draw a line and it's like going to go up because I said it so. It's going to be because enough people agree with your thesis, or you got there first. You bought before you bought before other people like jumped in the train and started buying. So the other thing I have, volume is what confirms either a move is real or not, right? And so at a basic level, every day in the exchanges, like if you have a low volume exchanges, then you have just the value area highs and the lows. And what the exchanges do is they just keep pushing the price up with perpetuals to go to the high, and then they keep pushing the price down. And the traders just get like knocked out because they're looking for breakouts. They're looking for like the new bull run. They're looking for like down only, and they have so much bias and they don't really see that the market like has just no volume. It's like kind of like you go into it's a guy asking out a woman on the day and she's like offering no signals, and so he's just getting wrecked. But it's like, is that the woman's fault? It's like, no, well, the guy's not reading the market. And that's just the same with a lot of traders. Is like they don't read the fact that there's just nothing there, but they project it onto their brains. And the way you find something there is like, well, is there volume, right? Is there actually like this open interest? Is there volume pushing the price up? So what else do I have is, yeah. And so like, and those trades are relationships. So it's like if enough people are willing to buy, at this zone, then the market makers can provide liquidity, and that's where you get this consolidation. And the other thing is just more about acceptance and like thinking about these levels as terms of, as sort of like a ladder, right? Like price is accepted here. If it's accepted here, then buyers come step in, and then it goes up here. If it's accepted here, buyers go in. But let's say it rejects from this level, but then it gets accepted and accepted, rejected, accepted. And so what I mean by price being accepted or rejected is that people agree to buy and sell those prices. If people don't, like, let's say I'm going to sell you a house for like $1 trillion, nobody wants to buy it, right? So the market rejects it. Nobody wants to buy my house that I'm selling for $1 trillion. Maybe nobody has $1 trillion, so that could be the case. On the other hand, like if I sell my house for like $10, flood of buyers, and it all gets bought up, right? And prices, people accept that I sold my house for $10. It was a bad trade for me. But when you're kind of thinking about Bitcoin, also it's like, okay, we're like, traders are not willing to enter the market until, let's say, Bitcoin enters like 22,000, right? And they're not willing to sell until it hits like 31,000. And right now we're kind of in the middle, right? Until somebody's actually willing to kind of push price up or down. And that's, as a trader, what you're doing is just kind of waiting for price. So let me a break. But yeah, that's kind of my ideas on just the basics of price action. I'll probably try to make a much more formulated thesis, but I have to go on a work project right now. So that's just kind of a Saturday morning thing. Hope you enjoyed. Have a good day.